Hey everyone, welcome back to the Commercial Real Estate Library Podcast. I'm Dama Tamanawala. You know my co-host Garrett McGilvery. And joining us today is the Vice President of Research and Strategy at QuadReal, Shawn Gilligan.
Thanks for having me.
Thanks for joining us. So very quickly, you guys I think have known each other for a little while. Me and you, Shawn, back when I was an intern, when I started at Colliers, I used to just harass you every day for information. I started on the capital markets team, and I would just go to you, and your face would always be like, "Oh, this fucking guy coming," in a loving way. So we go way back. It's good to see you. Can you please share a little bit about QuadReal and what you do there?
Definitely. QuadReal is a global real estate investment, operating, and development company. We're headquartered in Vancouver, British Columbia. Assets under management of $67 billion. And myself, I work out of Toronto, Vice President, Research and Strategy. So I lead the Canadian research team within QuadReal, and I also focus on global macroeconomics. QuadReal.
Awesome. Domestic advising on the domestic purchases, strategy. Garrett told me something like when QuadReal's buying a deal, they come to you and it's like, "Hey, does Shawn approve?" Is that true?
I wouldn't quite take it that far. We have a very collaborative work environment where research is integral part of the overall group at QuadReal. Research and strategy in general, and you'll hear it straight from our CEO down, is integral to everything that we do at QuadReal. We set global strategies for sectors of conviction, and it influences everything we do. So I'm quite in the lucky position.
Yeah. So I'd love if you could catch our audience up to speed on where things are today in the economy. We've got Bitcoin going like this. We got the housing market going like this. My cousin's calling me saying, should he sell his house that he bought 2 years ago, or should he hold it, rent it out? Is the housing market going to crash? What's happening? I think everybody's got a lot of questions. So maybe at a high level,
load that question up.
Can you take us through what you're seeing? Like, where are we right now?
At a high level about everything. I mean, geez, holy Dama, you're really putting me under the gun here.
And we could get more specific, but just to set the stage.
Of course, yeah, yes, of course, and so, dominating the news over the past few years, of course, inflation, interest rates. Never have these two topics arguably been so popular in the day to day, and of course, we're seeing a historically fast increase in interest rates. We have to go back to the 80s to see a period of time in which we've seen such fast, rapid interest rate hikes within 1 year of a hiking cycle. And that's all with the goal of bringing inflation back down to target. Our central bank is a single mandate central bank, and that's price stability. And so that's their focus. We all know inflation's been running well above target for the past better half of 1 to 2 years. And that's their singular goal. And interest rate hikes is their best toolkit to do so. And we're starting to see impacts to the real economy on those interest rate hikes thus far. You mentioned the housing market. That's an extremely interest rate sensitive segment of the economy. So those were the first to start to see the impact of this rapid rate hike. And now you're starting to see it flow through into technology sector, banking, consumer spending, and in all likelihood, we'll continue to see more throughout the balance of the year. I think that's why the Bank of Canada has paused. They're data dependent, so they're going to continue to see the information as it comes out, and that'll continue to influence their decisions. But they're at a point now where they've raised enough. We're in a restrictive territory in terms of where the terminal rate is specifically, and that's starting to put downward pressure on the economy. And so we're going to continue to see those impacts throughout the remainder of this year.
Sorry, I'm already off script, but have I was watching a CNBC interview with what's his name, the CEO of Starwood, who's always very anti-Fed. Oh, they've done too much. Let it ride. It's a backward-looking indicator. We're looking at data in the rearview mirror, and we've already raised too much. The real estate sector is going to collapse. Everything from everything. If you're listening to this guy. Have we already gone too far in terms of the rate raising in Canada? I know we're very different than the U.S., but
no. I know. That's there you go. Answers done. There was extraordinary stimulus pumped into the economy during COVID and after, and Bank of Canada, other central banks globally decided to hold interest rates at zero, essentially 0.25 until 2022. So the reversal of that extremely accommodative policy with substantial stimulus, quantitative easing, interest rates at a really low level, that was a big factor in increasing inflation, the inflation that we're seeing today, although there's supply and demand factors at play on the inflation side. But nonetheless, the reversal of that extremely accommodative policy comes with a lag. When you are trying to dampen inflation that was partially caused by stimulus, you need to see the lagged effects of the rate hikes impact the real economy. And so it is too early to tell. We still have core inflation well above target, headline inflation well above target. Those are lagging indicators. So I do understand the
target 2% right now?
The target's 2%.
Okay.
Yes, 2%. Within a band, 1% the low end of the band, 3% at the high, but 2% is that goal. And inflation is a lagging indicator. If you look at most leading indicators, durable goods orders, PMIs, yield curve, it's showing a slowdown. It's showing that the interest rate hikes thus far have and are having an impact on demand. But CPI, unemployment rate, wage growth, et cetera, the things that the central banks and Bank of Canada specifically keeps pointing to, they're going to need to see some of those lagging indicators show meaningful movement down to the 2%. That's what they've continued to be messaging. And so that's all that we market participants can go off. We can look to the impact that the rate hikes have had and are having, but a central bank that continuously says our number one mandate is to return inflation back to the 2% target, we need to continue to go down that course.
Is it true? Let me know if I'm hogging the mic here. I've got a bunch of these. Now they're all coming to me, all these questions. Is it true that Canada, the Bank of Canada, is more effective at managing the economy than, in terms of slowing the economy, than the Fed, just based on how maybe the structure of our 5-year mortgages versus 30-year mortgages or whatever? Like, is there something like that?
So there's a little bit of dynamic to that. I wouldn't say more effective.
Less important, sure, but I mean more effective on our little Canadian segment.
Yeah, what I will agree with is if you look at the composition of GDP in Canada versus the US, there's a greater share of GDP in Canada within those very interest rate sensitive segments of the economy.
Real estate.
Yes. So the housing market in general. So their main tool, although they have others, but their main tool, interest rates, whether you're raising or cutting, generally will have a greater impact on the overall Canadian economy because of that relative share.
is there, follow-up question, is there any market that is more dependent on real estate than Canada that we could look to and say, well, that's what's going to happen, and then we're what's going to happen, and then the US is what's going to happen?
There are some other markets that are similar, but within the G7 specifically, Canada does have a high relative share of GDP to housing versus other countries. You could look to Australia, you could look to New Zealand, you could look to a few others, and they're seeing a slowdown in the housing market as well for similar reasons. In Canada, we do have OECD leading population growth, so there's a bit of a dynamic in terms of housing market demand, rental market demand that fuels the environment that we're in. But just specifically on the interest rate side of things, Canada's relative share of GDP in the housing market does make it generally more susceptible to movements in interest rates.
Now, help me tiptoe if we have to here to be sensitive to, a big organization. But can we go through maybe asset class by asset class and talk, just to put it in context, I'm in multifamily. I get calls every day from the smallest private guys to the largest institutions saying, what is happening in the market? Transaction volume has slowed down. We don't really know where things are. You'll see something transact at a 3.3 cap, and then an identical property will transact at a 4.25. And so people are trying to figure it out. I have an idea, at least in multifamily, but I'm really curious to know, why don't we start in a happy place with industrial? Where are you seeing things, speaking about all of Canada, not just Toronto, at least MTV, where is the industrial market now, and where is it headed over the next couple of years?
Yeah, the view on industrial for Quadrill in general, extremely high conviction asset class globally. And within Canada, we've seen such substantial growth within the industrial market over the past 10 years, really 5 years. And that's a trajectory that I think will continue to grow extremely strong. You have your traditional cyclical economic factors where a country of Canada's size that's growing to the extent that it is. I'm sure you saw Canada's record-breaking immigration numbers for 2022.
How many people did we?
Over 1 million people.
1.05 million.
1.05. And, that number, which, yes, is processing of visas from previous years, but nonetheless, that puts us on the upper range of the target that the federal government has sent out. And that range is growing over the next 5 years up to 500,000 net new people a year, not including international students, not including people on a temporary work visa. And so from a macro perspective, the cyclical demand of overall consumption is a positive for industrial,
right,
as we continue to grow. But then if we fast forward 5 years from now, there's going to be a lot of change within the sector. One thing during COVID that was heavily discussed, and not quite as much anymore with interest rates, inflation dominating the topic, was the global supply chain shocks in the beginning of the pandemic and throughout the pandemic. And that really put a lens on cost of global supply chains, the efficiency, redundancy, automation, digitization. And so there's a lot of incremental productivity growth that can take place within industrial over the next 5 years. And I'm sure you're seeing and hearing it on the ground. And so that's a positive tailwind for the sector. And I think it's across the country. Calgary, Edmonton, Toronto, Vancouver, Montreal, markets across the country are seeing exorbitant demand in the industrial sector, and I think it's gonna continue.
Are there, just to throw some water on that fire, are there any meteors that are going to hit that? Is it a black swan event where you go, well, unless this happened, because one day maybe. and then we get to say you heard it here first.
Yeah, you can let
Quote.
yeah, direct quote. No, you can let me know your black swan event, but I don't see it. No.
So no concern over like overbuilding. We just don't right now. We just have zero supply.
Yeah.
Okay. All right. Industrial is great. So that's good.
Yeah.
Yeah. Okay. Now, why don't we continue through? You mentioned record immigration. Let's talk about multifamily then, because multifamily is one of these things where, each province has different different regulatory environment, but the fundamentals are so great, and yet it is extremely interest rate dependent, right? Like the values of these properties is directly related to interest rates, and so. Where do you see that market going kind of in the near term and then maybe medium term? Long term, maybe too challenging.
Yeah, I mean we can start off with supply demand, good old supply demand, and then go from there. And those population growth numbers that we just talked about, CMHC estimates there's about 75,000 new rental homes built last year. Average over the past 5 years is around 50,000. Maybe we can increase that a little bit, maybe over the next few years. We have vacancy rate under 2%. And those numbers that I quoted in terms of new supply, that doesn't count inventory that's taken out of the market, inventory that could use an upgrade. When you set growth targets of 500,000 people a year, that's an extremely positive demand driver for the overall economy. But there's not many folks that would say today there's enough rental stock in the overall market. Quoting those numbers, you think that's a big gap. We're only adding, even at a peak, 75,000 rental units a year. Vacancies barely budging. Rent growth is extremely positive. So overall, I'm very positive on multifamily supply demand overall. It's just a question of bringing on more supply to satiate that demand across the country, really. Some jurisdictions easier, more difficult to, but there needs to be more supply.
Yeah, when you're bringing in 1.05 million new immigrants in a year and only 75,000 new rentals, like where are these people going?
It's not great. Yeah, and that obviously with all of the pros, the risks are, if the fundamentals are so good, then the risks are more regulatory, because it's you have at the same time low vacancy or less than 1% vacancy in certain markets. You have turnover going down to the low single digits, and all of a sudden you can't get anybody out. Rental becomes a front page issue with affordability and protesters and all this stuff, and it becomes tougher to generate churn to actually get a return on your investment as well, right? So,
yeah, and that's why the number that I quoted was purpose built rental, not including the condo rental to the market.
Right.
Purpose built rental is needed across the country. Every market you look at, and in my opinion, transparency is the name of the game. Governments across the country, many are understanding that this is necessary piece of infrastructure, piece of the economy that fuels growth. Without adequate housing options, rental options specifically, because the numbers that we're talking to don't include international students. A lot of folks that come to Canada go to rent off the bat, not sure if they're going to stay in one city versus the other, maybe looking to find a home at some point. Coming back to that purpose-built rental, it's a story of supply, and some markets across the country, it's easier, more transparent to bring supply than others.
There's an elephant in the room sitting right over there. We've been all trying to avert our eyes, but staring at us.
Look out.
His name is Office.
Yes, we're sitting in one.
Yes, exactly. We're the only three people in here. No, I'm just kidding. Our office is pretty packed actually right now, I think. But okay, so just diving into this a little bit. In Toronto, I'm not an office leasing guy, but in Toronto, I think our downtown has a vacancy rate of like 10% or something right now. And Toronto is a great market for office, right? But we're still feeling the effects of COVID, work from home policies. There was a while where employers were mandating return to office, and I think that people are still trying to do that. I'm a big believer that you have to work in the same space to be effective, or a lot of people should. Let me rephrase that. I'm a big believer that not everybody is effective when they're at home. But yet vacancy rates are still high, and then availability rates are higher, right? Because you have these rolling leases, and then companies are either not renewing or they're downsizing. And this may just be a temporary thing, but we have seen a little bit of pain in that sector. So how do you guys think about maybe office across Canada? And you can bifurcate that from suburban, more central, however you're thinking about it.
Yeah, I'd say long-term investor. I'll say it a million and one times. Really look at markets where there are positive long-term fundamentals, and we look at Toronto, Vancouver, and other markets across Canada. But I'll stick to Toronto since you mentioned it. Office jobs added over the past 10 years have been substantial. Amongst the top in North America, very diverse employment base, lots of growth, technology, finance, real estate, legal. And so personally, the view is that that'll continue. That'll continue for the next decade plus for Toronto. It's going to continue to be a growth engine for Canada. You'd mentioned work visas. It's a substantial landing spot for folks globally. And that's a substantial positive demand driver for office in the long term. You'd mentioned a lot of the dynamics of office specifically. I think right now you're seeing a noticeable flight to quality. A pandemic is going to cause that shift. HVAC systems, amenities, engaging space, etc., was bound to happen with a new supply pipeline coming to fruition anyway. But I personally believe the pandemic accelerated that. And when you look across the country, gap between Class A and above, Class B and lower vacancy has never been this wide. And when you look to individual markets, sub-markets, that's reigning true. So when we look over that long term, again, we focus on long-term fundamentals. And right. Toronto, Vancouver, very positive. And then we specifically focus on that flight to quality, that space that allows for all the things that you'd mentioned, very engaging work environment, positive amenities, et cetera, et cetera.
So that makes a lot of sense to me. And we keep hearing the flight to quality. So maybe our MTV markets are going to remain strong, right? Or at least rock bumpy road right now, but there's a path towards they're going to be a huge success and everybody will wonder why they didn't buy today. Maybe. One thing that I'm like, this is kind of building on that question of what's happening in the US that, maybe Canada is better in a lot of respects.
Go Canada.
Hockey,
Go
lacrosse,
Canada.
Whatever it is.
Hockey.
But like a lot of what happens in the US affects us here, whether it be, their real estate sector is getting pummeled much quicker than ours in a lot of respects. And, maybe they have a more liquid market. Maybe they're doing the 1031 exchange. Maybe, who knows, whatever. It's a much more entrepreneurial spirit down there as well. Things move quicker. But like, what are some of the knock-on effects that, like, is there another shoe that's going to drop and potentially affect our Canadian market here in any sector, whether it be the asset class specific or some of these banks that are hold all of these loans for all of these office buildings, for instance? Like, is there anything that you guys are saying, okay, well, we should just monitor this?
Yeah, I mean, you said it well in terms of a lot of what happens in the U.S. impacts Canada. Hiring at major American companies in Canada has an impact on the economy. Interest rate policy has an impact on Canada. So the direction as to which U.S. monetary policy goes, that'll have an impact on Canada to a certain extent. Firm growth within the U.S. will have an impact on Canada as companies are continuing to grow going forward. The ones that have a presence in Canada will be a net benefit. So there's definitely knock-on effects. There are nuances within the market in terms of faster population growth in Canada.
Right.
So that's one aspect of growth that's different in Canada versus the US. We see more concentration of growth. Alberta, Quebec, Ontario, BC, and the major metro areas garner a majority of new entrants to Canada. There's a lot more regional competition in the US specifically. There are a lot more regional banks, a lot more banks across the US, over 7,000. Canada, 28. So when you look at Canada's relative impact on what takes place in the US, there's generally some trickle effect, but I would say there are some nuances.
Is the Canadian banking sector going to collapse?
A hard question.
28 dominoes.
No.
Okay. All right. Good. There we go. I feel safe. Do you have any?
The one thing that I see from the majority of this conversation is that, like, the one thing that seems to be a major saving grace to pretty much every asset class that we've talked about and the Canadian economy as a whole is really just immigration for the most part, because that's been propping up our demand so significantly that, housing's never going to go down. Industrial needs to be revamped because we need to, service more people. Office, more people coming in, more office jobs, more people coming in, right?
Yeah.
This could be obviously a no. Is there ever is there potential backfiring effect that could ever occur with, spiking immigration into a country? Like
affordability?
Aside from affordability?
Yeah, I would say, we touched on it a little bit earlier. When you look globally, Canada's growth, population growth, leading the OECD. It's at the bottom of the OECD in terms of 35 advanced economies globally. Canada, and whether you break it down to the G7, G20, generally speaking, Canada's at the top, if not near the top in terms of population growth. It's generally at the bottom or near the bottom in terms of timeline to obtain a general construction permit. So growth
That's
is
interesting.
a positive. The challenge is whether it's infrastructure that helps growth be more productive, public transit, R&D spending, et cetera, whether it's that or housing, industrial infrastructure, et cetera, all of that needs to keep pace. A lot of economies are seeing slowing, declining working age population growth, flatline population growth. That has a whole host of macro challenges. We're in a very positive, beneficial position, especially as I had said, you have permanent resident, non-permanent resident, temporary visa, international students. All huge positives to the economy. You need the productivity growth. And Canada's lagging productivity growth also in the lower quartile, generally speaking, more R&D spending, more efficient infrastructure, use of funds on infrastructure, more efficient, faster construction of housing, sewer systems, public transit, et cetera, et cetera. That's the crux of the problem. Often the conversation gets diverted to, what should whether it's GDP, population, or other, what should the growth target be? And not enough time spent on infrastructure and productivity growth, et cetera, et cetera. That needs to be the crux of the conversation. And that's the one out of the positives mentioned today that really is lagging, that needs to be kickstarted, for lack of a better phrase.
Okay, wave a magic wand. How do you make that happen?
Well, infrastructure is one of the ways that I'd mentioned. Efficient infrastructure, spending, delivery of infrastructure, hopefully on time.
Right.
And to your productive regions, housing, rental, ownership, et cetera, just overall housing across the country, and R&D spending, whether it's public or from the private sector. And you need to create a more efficient, competitive environment to then encourage businesses to spend more in R&D specifically. And that's lagging.
Got it. Okay. This is a challenging question. Have you ever read Peter Thiel's 0 to 1? You know that one?
Yeah. So what's your challenging question?
Well,
was it if I read it or?
Yeah.
The answer is yes. Yeah. Next question. Yeah.
Okay.
No, but in it he asks, now I'm going to butcher how he asks it, but it's like, what's one truth? What's one thing that you know to be true that very few other people believe?
I'd have to say we're not going back to 0% interest rates in the near future. That's a hot debated topic today, but we're coming off a period of extremely long, accommodative monetary policy where interest rates were lower for longer. And I think for the next few years, we're going to have higher interest rates that'll make things more interesting for us in the day-to-day.
Okay, just to play this out, because that actually it makes me think about say multi-res. A lot of people will buy, like if you believe the opposite thing, which a lot of people believe, that rates are going to go back down and start cutting, in whatever end of this year, early next year, then that would look like, okay, I'm going to buy this real estate, I'm going to lock in a very high 2-year loan, and then I'll refinance when rates are down. You're saying maybe rates are not going to go down that quickly, so you're still going to be.
Yeah, you need a lot of cuts to get where we were, and we'll get cuts at some point. Rates will go down a bit, but for the near term, will be higher than what we've seen over the past 3 to 4 years for sure, and higher than the last cycle. But in that go forward, income growth, and that's the name of the game. And multifamily, industrial, and specific, those two sectors across Canada have really positive income growth stories. And so the dynamic that you're discussing is still extremely positive, even in a higher interest rate environment, because you do have that positive view of income growth over time. So it's different because rates aren't quarter point as they have been throughout the pandemic, but you still have a really strong rent growth story.
At the end of 2025, where is the benchmark, Canada's benchmark rate going to be?
This will be the big caveat asterisk. Don't listen to anything that I say. It'll be higher than where it was in 2019.
Oh, okay. Fair enough. Last question. You have $2 million and you can invest it in any asset class anywhere in Canada, and $2 million in equity. Where are you putting that money?
A Toronto or Vancouver industrial condo.
Okay.
I'll put it there.
Fair. Good answer. Okay. Thank you guys. Thanks so much for joining us.
Great. Thank you for having me.
Garrett's just over there. Thanks, guys.